The Fed is imploding the economy and bankrupt. Amid the global economic crisis, the Federal Reserve has been under intense pressure to turn things around, but the results have been a far cry from what U.S. Federal Reserve Chair Jerome Powell had hoped. As its balance sheet continues to go negative, the Federal Reserve is close to insolvency and is effectively bankrupt. The United States Federal Reserve, whose purpose is supervising and regulating financial institutions and activities, has driven the world's economy into a recession and possibly a depression. The Fed, the force behind the global economy, has long operated partly to make money. But lately, things have changed, and the Fed is now in the red. Hello, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. The Federal Reserve has been in the spotlight for the past 3 years, but things have turned out differently than U.S. Federal Reserve Chair Jerome Powell had in mind. In fact, because of how bad things are right now, he has been labeled a complete failure. In addition to bankrupting the world economy and plunging us all into a depression, the Federal Reserve is on the verge of insolvency as its balance sheet continues to become negative. The Federal Reserve asserted that it had two goals: to keep inflation low and preserve price stability, as well as to maintain a healthy labor market and high employment rates for Americans. However, the Federal Reserve has a second, less-known goal: to generate profits. In addition to printing money, the Federal Reserve also aims to turn a profit, which it has been doing since around 2011 due to an increase in asset values overall. The Fed, the engine driving the world economy, has been in business partly to make money for many years. However, things have changed recently, and the Fed is now losing money. They are required to transfer any earnings they make to the U.S. Treasury. However, they had returned almost $2 billion during the previous 5 years. In contrast, as 2022 ended and the economic climate deteriorated, the Fed abruptly lost $20 billion instead of earning $2 billion. This circles back to the very same factor that led to the financial crisis we have just witnessed in the United States. The Federal Reserve has trillions of dollars worth of assets, including treasuries and mortgage-backed securities, but the price of these bonds has been slowly declining over the past year. The Federal Reserve is now holding trillions of dollars in paper losses. This is not an issue so long as the Fed does not sell these assets. The Fed, however, has been selling these assets in an effort to reduce inflation. As a result of these sales, the Federal Reserve has reduced the money supply. Furthermore, they have tightened the economy and begun quantitative tightening, indicating they are experiencing losses on these assets. They purchased them for a particular amount of money and are now selling them for significantly less, resulting in real losses of $20 billion. If the Fed keeps doing quantitative tightening and selling its assets at a loss, it will go bankrupt because every time it sells these assets, it lowers their value even more. Additionally, increasing the Fed's exposure to these declining asset values by printing more money and buying more assets would only make them more bankrupt in the long term. Moreover, the Fed printed $300 billion last month to alleviate the financial crisis, driving them farther into the red. Fortunately, the Fed has a legal accounting trick called Deferred Assets, allowing them to conceal these issues. This keeps them from admitting they have problems, but it doesn't solve anything. To prevent its balance sheet from turning negative, the Fed must acquire some form of asset, and in doing so, it is effectively issuing itself an IOU for expected profits in the future. Just as Enron did 20 years ago, which resulted in the worst corporate fraud in American history, the Fed is essentially making up future earnings out of thin air and marking them down on their balance sheet. The only difference this time is that the scam is perpetrated by one of the world's most established governmental bodies. Unfortunately, just like how a bank can pretend the problem doesn't exist since it's not forced to mark down bond losses as genuine losses, this solution does nothing to truly fix the underlying issue. Now, some may argue that $20 billion in losses pale in comparison to the Fed's balance sheet, which is over $8 trillion. However, the Fed's equity, not the balance sheet, is what actually matters, and things there aren't looking so well. The Federal Reserve's equity is now at $28 billion, and the Fed has lost over $20 billion due to quantitative tightening during the past 9 months. If things go on like this threat becomes much more serious. The Fed will become insolvent if it continues to incur such enormous losses. Moving along, the Fed is free to act whatever they like without being held accountable, yet this covers rather than addresses their issues. The only thing it does is sweep them under the bed for someone else to handle. The Fed was already unsure of its course of action, and the worsening bond crisis meant much more market instability and perhaps even more bank failures. Even Ken Griffin predicted that American capitalism was imploding in front of our eyes with the collapse of Silicon Valley Bank, and now JP Morgan predicts that the S&P 500 might fall another 20% as the economy stands on the verge of a disaster. So it should come as no surprise that approximately 90% of financial advisors will heavily invest in alternative assets to lower volatility in the next 2 years alone. If the economy continues to decline, the Federal Reserve's solvency will suffer along with everyone else. The main uncertainty at this moment is whether a recession or a depression is on the horizon. By printing money over the past 15 years, the Fed enabled this inflationary atmosphere to take hold, and now it is finally starting to bite back. Inflation is still way too high and is not falling fast enough. Additionally, the U.S. Consumer Price Index is currently resting at 5%, which, according to reports, is fantastic news. But the current CPI is 1.5 times the intended level, and it will take a considerable amount of time to get it down to the target level of 2%. Moreover, the headline CPI data for the month of March decreased by 0.2%, less than what experts had predicted. However, when looking at the figures that the Fed themselves claim are the most significant, prices still increased by 0.4% in only 1 month, which corresponds to slightly under 5% on an annualized basis. Perhaps one might argue that inflation is over and done with if price increases had ceased entirely, and the annual CPI data we keep coming through were residuals from the previous year when there was still an energy shortage and the interest rates were still at 0%. However, this is not the situation at all. Even though interest rates have increased by 5%, monthly annualized inflation numbers remain at 5%. This indicates that the Fed still has a long way to go in its war against inflation, which implies that interest rate increases will continue to occur month after month. So far, these increases have caused a financial crisis that has led to 2 of the greatest bank failures in American history. Many more banks would have failed if the Treasury hadn't effectively declared to bail out every bank in America if necessary. Over the past 3 years, the media has consistently misinformed the public about the state of the economy. Since the economy is still red hot, the Fed will likely continue to raise interest rates. Moreover, the labor market has been marginally impacted, but not to the degree that would be sufficient to combat inflation. In other words, the Fed will continue to raise rates until the labor market collapses, or until something else does. Similar to the banking crisis, the Fed will be required to make a decision once more. At that time, they decided to print $300 billion over a week to bail out those banks, maintain their solvency, and prevent an immediate collapse of the nation's economy. The Federal Reserve will probably make a similar decision during the next crisis and favor short-term stability over long-term stability. That almost certainly indicates that inflation will remain high for some time. Powell ends up becoming the very thing he's been so afraid of over the past year, a disgraced Federal Reserve chairman who must step down so that someone else can take over and save the day. If things worsen, we'll be on the verge of an extended economic downturn that impacts everyone. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.